Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. My guest today is Beau Eckstein from Emerge Lending, and we are going to talk about how to look at deals from a lender's perspective, among other things. Emerge Lending does a lot of types of loans, including commercial lending, construction loans, business loans, hard money, and bridge loans, to name a few. Beau has been in this business for over 20 years. He does residential and commercial finance and business consulting. He is a licensed California real estate broker, and he also operates a consulting company that helps businesses grow and their business by providing commercial mortgage advisory services. He has a large network of bank and non-bank lenders, and I can't wait to dive into this topic. So you might be wondering, this was a question a lot of people have, what is the best way to approach a lender for money to fund your project? And that's one of the things we're going to talk about today. Welcome to the show, Beau.
Thank you. Thanks for having me. I'm excited to be here.
So I touched on just the kind of the highlights of your experience. So why don't you tell everybody a little bit about yourself and how you got into this particular business?
Sure. So growing up, I always wanted to be in either real estate or I wanted to be in law enforcement. And I was in high school. No, actually, the year after high school, I was working as a loss prevention officer at a department store in a high crime area. And it was fun. I would catch people shoplifting, and we were plain clothes. And they didn't give us any tools or training. And one time, a guy pulled a knife on me. He was far away. I don't think they were. And then I just thought, well, this isn't really fun. So I ended up meeting somebody at the gym that I would work out with, and he was in the lending business. And he said, well, you should come work for the company. And I wasn't licensed at the time. I said, sure. So I got in there, and I was probably like 20, around 20 years old, 21. And I was their telemarketer. And I got so good on the phone. I'd call people, I'd get all the information, I'd fill out the lead sheet. Then I'd give it to the loan officer, and then they would make thousands of dollars on commissions. Mm-hmm. So I quickly got my real estate license. In California at the time, you needed your California real estate license to originate residential loans. And then I went and worked for mortgage brokerage companies. Did that for many years. And then the 2000 started buying a lot of houses prior to 2007. And I was doing a lot of what I call speculation. And unfortunately, if you were around in 2007 or 8, you realize if you were a speculator on the West Coast, you really got hurt. And that's what happened to me. I was in my mid to late 20s, and 2007, 8 rolled around, and it annihilated me basically. And so after that, I was like, well, what am I going to do? The lending business was shut down. I had non-cash flowing properties that I was speculating on. So basically ruined my credit and just was depressed. And the last straw really was for me was I was living in Nevada at the time because I moved to open an office for a large brokerage. Moved back to California, and I was got back in. I said, well, all I've ever done is real estate and loans. So I was selling houses and trying to do loans, even though the market was very tight. And had creditors calling me and everything. And I had no money and couldn't get credit. So it was a very humbling time in my life. And I remember I called my brother, who was always very good with his money. He's in financial service industry. And I was just talking to him, and I started to cry. And I'm like, man, can you help me out? I'm pretty screwed right now. And he ended up sending me $5,000, and it kind of changed everything because I just didn't look back. And sure, over the last 20 or 15 years or whatever it's been, there's struggles in real estate, but really learned some valuable lessons about getting yourself into too deep and not understanding how to buy cash flow properties. And so I spent the last 15 years educating myself. And then in about 2009, one of my friends, I didn't realize, was a manager of a private mortgage fund in Northern California. So I became their marketing arm and started originating hard money loans for these groups. And so I was lending money to house flippers. I quickly realized that I could do this. And I said, well, I have bad credit and not much money. How am I going to do this? And that's when I just thought, well, why don't I just effectively partner? Let's partner with the contractor and let's partner with the money partner. So that's what I did. with no money, and we would just deal. I'd find these deals, I'd put them together, and then we'd just split them three ways, and we just
Mm-hmm.
kept on doing that and doing that. And then we started doing deals on our own. I would partner with different people. Uh, then I'd start doing deals. I would do them by myself as well, and I'd always like to partner because it just spread the risk when you, especially in
Yeah.
California, the prices of real estate are so high. And then just really focused now. My focus is investors, and that's what I've done for like the last, I don't know, 12, 13 years. And over the last 5 years, I go, well, let me work on these bigger commercial deals too. I still have these clients that are flipping properties, and those are easy loans. But now I do more complex loans, people buying and developing larger properties, self storage, and I have a guy right now that's buying an old car dealership, and he's going to start a new concept where he's going to sell green electric cars. And this could be huge, right? Because that's where the trend's going. So
Mm-hmm.
that's a $4 million deal. We can do pretty much any size loan. We have connections with private debt funds and all that good stuff. And over this last 12, 13 years, I did a lot of house flipping. I started buying out of state, went to Indiana, started buying cheap rental properties. And so it's a constant journey. And now I'm looking at investing in self storage and larger properties. And eventually would probably get into doing syndication. At this point, I'm just doing JVs and real estate deals myself.
So one of my questions was going to be, did you stay in California or venture out? So you've ventured out into Indiana, like northern Indiana. Is that where you are, or Indy or
Yeah, I'm in South Bend, Indiana, and then I
South
also
Bend?
have, yeah, I have holdings in Pennsylvania as well. I started buying in Pennsylvania this past year. But I prefer uh, cheaper housing markets. I feel like
Mm,
if you're going to buy and hold for the long term, they're stable. They don't appreciate as much. Although the last 5 years we've seen tremendous appreciation. And I like that model. You just need a lot of these smaller rental properties. I buy a lot of duplexes and fourplexes.
mhm.
So now I'm working on trading up because a lot of my colleagues are very successful in real estate, and I just look at what they're doing, and it's a progression. And they
Mhm.
end up, a lot of them end up becoming syndicators of some sort, and they're buying large properties, and they get paid very well for being able to put together deals and raise money.
Mhm. So you mentioned in some of your information that you work with non-bank lenders, bank lenders and non-bank lenders. So am I understanding that you are like kind of like the middleman and you find the source of funding that best meets a person's needs?
Yes. So I have some direct, I would say direct relationships that I don't work as a broker capacity. It's more of a correspondent. But the majority of loans I get are broker deals. So somebody comes to me, and let's just say that it's a fix and flip deal. I find out where it is, how big the construction budget is, what their experience is, and the caveats of the loan, and then I figure out where the best home is because each lender has a little bit different appetite of what they like to do. Some of them will only do a 12-month term. Some will do 24 months. And so if you're buying to fix to eventually rent out, then you might want a 2-year loan just to give you that enough time. So I really get in with the customer or the client, and then assess where they're at with their real estate journey, and then figure out what the best loan program is. So 20 20 plus years, I can give people really good guidance versus being like a cookie cutter type of cut where you go to one
Mhm.
lender and he says, go here. And usually my terms are as good or better because I shop multiple lenders and I know based on the scenario where the best and the cheapest cost of funds would be.
Now, do you have any private money lenders in the mix here?
Yeah, I occasionally have like trustee, well, in trustee states that will lend their individuals.
Mhm.
The majority of my business is either non-bank, which is like a non-bank institution, these large funds, and this business has really evolved. Meaning, back in the day, it was private lenders lending on fix and flips, and now it's these
Mhm.
big institutional funds. They
Like
fund the
hedge
deal.
funds?
Yeah, like hedge funds. They
Funds.
they fund the deal, and then they have these large like REITs and things that buy in the secondary market. We didn't have a secondary market in this business like 8, 9, 10 years ago. And
Hmm.
so that's why this business has absolutely transformed completely. But the bad thing is when recessions or downturns happen, these REITs or these end buyers in the secondary market,
Hmm.
they shut their doors, and that's what's going to happen again. I believe here shortly, it's going to get really tight pretty soon.
You mentioned on your website that traditional banks just aren't keeping up with innovation. And I love that because we talked a little bit before the show. You and I might think a little bit differently than some people. But I like the fact that you are an innovator. And I like the fact that people can come to you where you have a multitude of different ways to go compared to if I walk into what I would call my local investor friendly bank. They have portfolio loans. They're going to loan on the fix and flip or whatever it is. But they have a pretty narrow product. You're not going to ever get a government backed loan. It's going to have to be an in house loan, a portfolio loan. But there are not the options going to my local bank, investor friendly bank, that there would be with coming to your company. It's a whole different ballgame.
Yeah, I mean, there's needles. I call them needles in the haystack, where
Mm-hmm.
you find these amazing credit unions and banks that do like stuff that you can't even believe. And so I
Wow.
do sometimes place loans with banks and credit unions. I mean,
Mm-hmm.
oftentimes I do. It's so I have, I'll have an investor. I live in Las Vegas now. I had an investor here in Las Vegas, and she was buying a property in Kentucky, and she didn't have any experience. And so people buying commercial with no experience and out of state, it's very, very challenging. Plus, it was
Mm-hmm.
a sub $1 million deal, which is a small deal really in commercial. But I was able to find her an amazing bank terms because I've built. I think I have, I don't know, probably about 10,000 relationships with lenders in
Wow.
within LinkedIn and in my database. So,
Mm-hmm.
I mean, I really only work with probably 50 of them, but I created a way to easily source bank and credit union debt. Perfect example. One of my friends was buying a 20 unit property, multifamily, in Knoxville, Tennessee, and a lot of times people would look for what we call agency debt, which is Fannie and Freddie, small balance agency debt. Typically loans are under $8 million, sort of small balance agency. But the problem is that he didn't have the experience. You have to own like type property. You have to have a net worth equal to or greater than the loan amount, and have certain post close liquidity. He didn't fit those benchmarks for agency debt. So
Mm-hmm.
what did I do? I used my method, and I found him a credit union, local credit union that offered him unbelievable terms. Like I was like, this is unbelievably good. And so we do that all the time. I know how to approach banks and credit unions, um, the commercial department in a way so I can quickly find those needles in the haystack. And it doesn't always work out. It just, there's so many variables. I have a guy in Arizona who's has a 100 unit property in Texas, right? So I had to find him a bridge loan. So it's just figure out where the best debt is based on the scenario. That was a value add deal, so we use bridge financing, which is like a 12 to 36 month term. They hold back the rehab or the capex. In commercial, we call the rehab capex budget, and they disperse as he makes improvements. Then he stabilizes the property. So he bought it for, I don't know, he bought it for 4.5 million, um, and he was putting in a couple hundred grand in, and now it's, we're refinancing it now. It's probably worth about 5.3 million, give or take. So then we're going to put them in long-term debt. So bridge loan, you go in, you fix, you stabilize, and then once you have 3 to 6 months of good occupancy, then you're ready to take it out with either bank or agency, Fannie or Freddie, for these multi-family deals.
Now, see, I didn't realize they use bridge loans in commercial type deals. I mean, everybody's familiar with bridge loans. Back in the day when you used a bridge loan to before your house sold, it might be a while, and then you used a bridge loan to buy your the new property. But I didn't realize that was really a thing, using bridge loans in commercial financing.
Oh, I use bridge loans all the time. So um, I had a gentleman who it was in Texas. He was just rehabbed a house,
Mm-hmm.
and he was at 12% money. And then we could have refinanced into what's called a DSCR loan. DSCR loans are non-bank loans based on the cash flow of the property. You don't need your tax returns. They don't do a DTI. Like on conventional financing, we look at your debt to income ratios.
Right.
With these non-bank lenders, we do DSCR loans. And so, but the rates have gone up a lot with DSCR loans over the last few months. And so he was going to convert the property to a short-term rental. And so I suggested we did a 2-year bridge loan. So I worked with a national fund, and we did a 2-year term at 7.75 interest only, as opposed to going into like a 6.6 or 6.8 30-year DSCR loan. And then those DSCR loans either have a 3 or 5-year prepaid penalty typically. So now he's not trapped in. And so then he's going to get 12 months of operating history underneath him with his Airbnb. Then he's going to have VRBO and Airbnb printouts, and he can either then refinance conventionally because this income is going to be on his tax returns, or he can, if the rates come down, he can go into a DSCR loan, or potentially we can work with a credit union and do a commercial loan. So there's lots of options. So really, I feel like my competitive advantage and the way I look at it is that I am more like a financial planner, but for real estate finance. Yeah. And a lot of people just look at everything as a transaction. And I'm helping clients look 5 steps down the road. I don't do residential loans anymore, like Fannie Mae or FHA, but I do advise people, on how to get started in real estate. And like we talk about house hacking, maybe the first property, instead of I had a call. I still remember this call. It was maybe 6 months ago. And I was talking to this lady. She lived in San Jose, California. And I'm like, well, we were talking about she wanted to get started in investing. I go, well, what are you paying in rent? She was paying like $3,200 a month in rent.
Oh my gosh.
And I said, okay, how much you make? She had a great job, good W-2 income. I go, listen, your best move right now is to go buy a duplex, triplex, or fourplex, get FHA financing, live in one unit, live there for free, potentially make $1,500 to $2,000 a month profit, depending on what the numbers roll out to be. Take that money you're saving, that $3,200 a month plus that $1,000 month extra after you pay your mortgage. You live for free, so now you have $4,000 a month to save, and then take that $4,000 a month, or even if it was $3,000, right? You have $36,000 at the end of the year. Right. Go buy yourself a fourplex in the Midwest or whatever, and that's your down payment right there. Do that every year, or she could simply move out after a year, go do it again and again and again, and never really have to she could always do this model. So there's a million ways to invest, and I feel like that's where I bring the most value is just showing people easy ways to get financing. I mean, we have programs right now that will do 100% financing. If you've done 8+ transactions in the last 5 years, and that could be rentals or a combination of rentals and flips, we can lend 100% of purchase, 100% of rehab, and there's no payments due to you pay off the loan. It's a 12-month term. So as long as the gross loan amount does not exceed 75% of the ARV. So as long as you're buying it with enough spread in it, you can basically walk into deals with no money. Now, these are a little bit more expensive programs than the traditional fix and flip loans. We lend 80 to 90% of the purchase and 100% of repair costs. So you got to come in with 10 or 15%, plus you have to make the monthly debt payment and all that stuff. So that's cheaper cost of funds, but sometimes you don't have money, or you have 3 projects going at once. So the 100% program might make sense.
So what's the interest rate on something like that?
11 to 12% and a couple points.
Okay.
And on 100% financing, versus if we do 85 or 90% of purchase and 100% of repair costs, you're going to be at between 7.75 typically to 8.5 with our mainstream lenders. And then some of them you pay interest on what's dispersed only. Some of them you pay interest on the full boat, meaning the purchase price. So on a fix and flip loan, let's just say we lend 90% of the purchase price, and we then there's a $100,000 rehab budget. that rehab budget is held back in a construction draw fund, right? So you have to
Right,
make
right.
you have to make progress,
Progress.
and
Yeah,
an inspector comes and
yeah,
you get paid out a percentage of completion.
yeah. That's the way it always works here. Um, Typically, they charge $75 to come out and inspect the property, and I don't know if that's the way you all do it, but they charge a fee. They want you to, first of all, they want to make sure you made the progress, and secondly, there's always a charge in this area.
Yeah, no,
So
that, yep, there's definitely charge. The mainstream lenders actually charge probably about 160 to 220, I think, per draw. So I always tell people the important thing is that listen, do not over leverage, because if you can't make progress when you close escrow and get your first draw, you're going to be
yeah,
like behind the whole time.
right. It's hard to catch up once you get behind. So let's talk about financing. You hear people say all the time, I've got to have some money. I've got this deal and I've got to have some money. My viewpoint is you need to know where your money's coming from before you before you have the deal. You need to have some kind of a relationship with someone. So how do you set that up for people? When should they come to you if they, let's say they're a flipper and they're looking down the road, they're going to buy some more properties to fix and flip. When should they come see you about the money?
Sure. So um, whenever they have a deal and they want general information on, they can go and fill out a little quick
Mm-hmm.
form on my website, and I get the deal. I look it up. I figure out what the financing would look like. But really, if you're getting started in this business, or maybe you've done 1 to 5 deals, and over the last couple of years, so you got a little experience. What I tell everybody is you need a combination of lenders like myself and private lenders, depending
Yep.
on the deal. And so a lot of the ways I would structure my deals, I would get a fix and flip loan for 80% of the purchase and 100% of the repair cost. That means I need
Mm-hmm.
20% down plus carrying costs plus holding costs. And I calculate what that's going to look like. Then I would go find a money partner, and they would bring what we call the gap funding in, the difference.
Mm-hmm.
They would bring the down payment and everything in. So that, I mean, to me, everybody, we'd see these infomercials. People always talk about 100% financing. I mean, I've created so many different structures, and a lot of times without my own money. So it's very doable. You just need to know the lender that's making the loan. Will they allow subordinate financing? Will they allow a second mortgage on the property? A lot of them don't, especially these
Mm-hmm.
institutional lenders. They won't allow it. So in that situation, you can either have that money partner as a partner in the LLC that's buying the property, and perhaps they only own 19%. Most lenders, anybody that owns 20% or more of the LLC has to go on the loan, and so forth. Anybody under 20% doesn't need to go on. So they could be the money partner on the LLC. You always want to consult your tax person, your attorney on how to structure deals. I'm just giving you some educational tips. Um, the other way you could do it, I've seen people do profit share agreements, non-recorded profit share agreements for the private investor that's going to lend the gap funding. So really, it's kind of a three-prong approach. You need people like myself. You need a handful of private money lenders that don't mind being in a little bit riskier position. Build those relationships and find out where they're comfortable, where their comfort zone is. Are they comfortable not having a recorded deed? Would they prefer to be in the LLC as a managing partner, or a silent partner that owns X amount of percentage? And then that's how you kind of start structuring these deals. So you could structure them in many, many different ways. So you want to learn how to be a good deal architect. At the end of the day, that's the key. It's putting deals together, and I always enjoy that process. When I'm buying stuff, it's like, okay, all right, how do I leverage? How do I get other people involved? And yeah, do I share some of the profit? Yes, of course. But do I care? No, because what's my return if I have no money in the deal? Pretty good
Right.
return.
Right.
Um, if I had a boatload of cash, I would probably use a lot more of my cash. But most investors they're leveraged. Let's face it. That's how we kind of grow. And now, more than ever, I think is the time that you also have to be a little bit more conservative, because we're in a time where properties are going to start sitting longer.
Mm-hmm.
The market's going to normalize. You might see some price. You're starting to see price reductions. So this is when I think people some people will get hurt and get out of the business. There'll be a lot of real estate professionals that, we're going to have a transaction slowdown. We're going to probably lose 40% of our transactions because, right, like the move up buyers aren't going to buy because they got a 2.7% interest rate and they don't want to pay 6. So right now, I think we're going to see more of a transaction slowdown. So that means a lot of the mortgage people, a lot of the real estate people, like they're going to have trouble making a living. So you're going to see some retraction.
That's interesting. So the 19%, that's fascinating. So if they stay under 20%, that's what you said, they could be in the 19%, what I guess managing partner in the LLC.
Yeah, they could be a member.
A member.
Have it under 20%. So when you're talking to a loan officer or a broker like myself, we're going to kind of help you. We're going to ask these questions like, okay, where's the down payment coming from? Can we paper trail the money that's coming into the deal? Because no lenders or no title companies want money coming from some random. They always want to know where the money's coming from for anti-laundering principles to start with. So it's educating yourself to get these kind of basics down, and that's why talking to somebody and that understands the lending business can help you, guide you through. Like I've had some nightmare deals with like people in another country, they're not citizens. We can do foreign nationals. One person lives here, but the other, and then it's like, okay, they're sending me bank statements from Israel. We can't use those bank statements. So just laying out the deals to make them simple, because fix and flip loans are simple, right? There's
right.
Do you have good credit? Do you have any felony charges, any like fraud? Then you're probably okay. Do you have a credit score? Do you have actually a couple of trade lines on your credit report?
Yeah.
That all is kind of common sense. But after you do this long enough, you figure out you go with the stream, the river. You go with the flow, and that's what I got good at doing, is figuring out, okay, what's the easiest way of getting this deal with the best pricing? That's the basic bottom line. And that's how we're successful, is really like, okay, because a lot of times if you go with the wrong lender, they're not going to be able to perform in the time you need it to. So knowing like how fast you have to close and that kind of stuff is important.
I like the fact that you do business consulting. I'm sitting here just thinking about this whole landscape of someone, maybe they're doing a few fix and flips today. Maybe they want to start adding rentals. Maybe they need some gap funding there. When you get in that growth middle piece where you're trying to grow, you've got a lot of parts that aren't completed. You need a little of this and a little of that. So do you sit down with people and talk to them about, here's where you are, here's where I want to go, and this is what I'm missing kind of here in the middle? Yeah.
So I'm almost going to coin the phrase strategic finance coach is kind of what I was thinking, is that's,
I like that.
I know a little bit about a lot of stuff in the finance world. And so I have great relationships. So one of my friends, I sent him some training videos on buying short-term rental properties. And he's a residential mortgage broker, really sharp guy. He had a couple $100,000, and over the last 18 months, he's bought in 4 properties, and he converted one into a short-term rental. Guys, now he just sent me his invoices. He grossed $50,000 last month, and he made, last couple of years, mortgage brokers were making a ton of money. He had a big taxable concept. I mean, he's pretty good. I think he grossed like $600,000 in his mortgage business. So I told him, I said, listen, what you can do, even though you're not right at this point considered a real estate, and remember, I'm not a tax professional, but I interview people and I talk to people and I know these strategies so what I suggested he did is talk to a company I work with that does cost segregation, and then have that company talk with your CPA. So there's certain loopholes, right? Because it's not about how much money you make, it's how much you keep. So I said, Eric, you're not considered a rep or a real estate professional, but if you materially participate in this active short-term rental business, you can actually do a cost segregation study on these properties. Anyways, he had like $300,000 of offset against his $600,000 of income. So he paid, probably 80, 100,000, maybe $150,000 less in taxes just for that strategy. And so that's what I have the relationships where I give them, hey, talk to my contact here. Let's see if and let's get your CPA on the phone. Let's see if this makes sense for you, right? Because it's really, there's really a bigger planning. If you're always flipping properties, you're getting taxed at the highest level.
Right.
So why not keep some? Why not burr the property, right? Burring is you buy, you renovate, rent, refinance, repeat, right? And then you pull your money back out. Now you're in this property nothing after you successfully burr, and then it's a cash flowing asset that's appreciating. You're in the appreciation. Now you recycle that money and you do it again and again and again and again and again and again and again. And that's how a lot of people get rich with very little capital, right? They just take that 100 grand they have and they recirculate it as many times as they can. The velocity of money is the key. And then as you're building this wealth, how can I lower my tax burden? That's a huge component of it, right? My friend that is a very successful multifamily syndicator. He said, I think it was last year. He said, he made $4.2 million last year. And he goes, well, I had $5.4 million in write-offs though. And so people always go, well, how do these really wealthy people of the world, like, how do they pay no taxes? Because they use these tax advantages like cost segregation and all this stuff. So as a real estate investor, you need to learn all this stuff. I routinely run into people that are just making huge money, $1 million a year W-2 in the San Francisco Bay Area where I used to live, and they have no write-offs. And I'm like, guys, you should be paying attention to these loopholes that are legal, and you should be going to these classes on the weekends. I mean, there's so much good information out there that you should invest time to like grow your business that way. So that's what I enjoy doing, is really kind of helping people, giving them my Rolodex per se, and giving them a little bit of guidance to help them really scale their businesses.
Well, you've hit upon an important point here, and that is most real estate investors, I'd say by and large, they're just investors. They go do the deals, they make the money, they hand it all over to their CPA. They're not looking to have other advisors, wealth advisors, tax advisors, loophole people. They have not invested in putting out the fee to get those people into the world. And there will be a fee associated with that unless you learn it all on your own. However, you'll keep a whole lot more of your money.
Yeah, I mean, I have a couple different LLCs, corporation, S corp. I have to pay fees on all these, right? Every year, I have to have I have to have a bookkeeper now. I have to, and I was never really organized in that way, and but at the end of the day, if you kind of figure out how to tax plan and how to like best do this, you can pay very little taxes, right? You can pay next to nothing if you have businesses or if you understand these strategies. And so it's out there for all of us to know. It's just who's going to take advantage of that and who's not going to take advantage of it. Right. And quite honestly, I'm passionate about this now because it's like, okay, if you surround yourself with very successful people, you're going to learn from them. Right. I find myself comparing myself against them, like, what are they doing differently than I'm doing? But I just surround myself with people that are really smart and that just are go-getters. I've seen people. I just interviewed somebody on my podcast. He went from like no self-storage units. Now he has a portfolio over like 250 million in assets under management that he owns, self-storage, and he did it in 5 years. And you just think about the cash flow this guy makes on a daily basis. Unbelievable, right? And then I watched this other guy over the past couple of years. He was very successful to start. He owned some martial art academies. Young. I think he's 32 now. And now he has he can retire at 32. He makes $100,000 a month in passive income, and he's got a management company built, and like he took himself out of the equation at 32 years old. And it just fascinates me how these people just can do this. And for me, I think you got to look at what your number is. And I don't need to be, this guy over here that wants to be worth $100 million. I don't need to be that guy. What do you want? in your life? Let's start there, right? What do you want in your life, and how do we set a plan to get there? And that's really the goal, is how do you set the plan to get where you want to go? And that could be $5,000 a month of net passive income. That could be 10,000.
Mm-hmm.
I highly recommend for anybody out there that your first goal that you put on your vision board is to become a 100%er. And a 100%er means that, let's say it costs you $7,000 a month to live with food, mortgage, rent, entertainment, all that stuff. And so our first goal is to get, little by little, stacking bricks to get to $7,000 a month of net passive income. Now we're a 100%er, meaning we could live, we're balanced out. We don't need a W-2 job. We don't need a job. Now we're a 100%er. Then you go to a 150%er, then a 200%er. As you become a 200%er, you're just really taking your passive income and reinvesting and making strategic plays. And so if you set a goal for to do this in 10 years, it's very achievable. I've seen people do it in 6 months, where they set a number and they got there and they're financially free within 6 months or 12 months. I mean, that's not usually realistic for many, but even if it took you 10 years to do, right? Like if you don't start today, then when are you going to start? And that's the real key of it. And I look back about all the mistakes I made in general. I've owned so many houses that I sold because I was in this selling mentality. The first house I bought, I couldn't qualify at the time. I was 22 years old. It was in San Ramon, California, very expensive area. And I negotiated to do a lease option. So I said, his name was Greg, the seller. It was a townhome, beautiful townhome. I said, Greg, I'll pay you $300. I'll lease the property for 12 months with an option to buy. So it was all in a contract. It was a lease with an option to buy. And I have 12 months of leasing, and then I have a 3-month window to buy, exercise the option. And the option price was $325. And then, anyways, I got 2 roommates. It was a 3-bedroom townhouse. I got 2 roommates. They helped offset my costs, obviously. So I was doing house hacking before house hacking was around. And then it came down to the time where I was ready to exercise the option, and they had a program. This was years and years ago, where it was like a lease option purchase. And they would use new appraised value, and it appraised at $375. So in 12 months, I created $50,000 of equity. I was able to refinance, which was pay Greg, and Greg, I exercised the option to buy the property, own the property. Kept it for years. I ended up moving to Lake Tahoe to open a mortgage company, and I sold the property. And I was just looking at it the other day. That property out for $325 is worth $1.3 million right now. So why did I didn't understand the strategies of renting the property and just breaking even and just playing the appreciation, or I could have turned it into a furnished rental and maybe got additional cash flow. Right now, the strategies are out there for all of us to take advantage of it right now.
Well, we didn't know what we didn't know, Beau.
Yeah.
That's just the thing of it. You look back and you wish you'd kept every property you sold. But, if you get in the wholesaling mentality or whatever mentality you're in, you're just not in that frame of mind. Well, this was great advice. And that advice you gave people at the end to find their number, that's always rock solid advice. I like the 100, 200% analogy, though. Do you have any other final advice for folks that, are in the same situation?
Yeah. So my advice, and I tell myself this every day, is listen. Like today, I was like, I got to do a continuing education class, and I have clients I need to call, people I need to call, right? And we get kind of in these modes of I don't really want to do this stuff. And what I've gotten really good at doing in the last 2 years, because I realized that you just have to do this. You have to be ultra consistent, okay? My marketing guy and I, we always talk about moving the needle 1% or a little bit each day. Move the needle, whether that's looking at properties on Zillow and then putting them into a spreadsheet, creating simple processes. Like I said, okay, this year I didn't buy any properties last year because I was busy with work, and I said, I need to just create a simple process. I want to buy at least 3 doors, which is not a lot, right? But when you're busy with two businesses, it becomes a little bit of a problem to like get outside and start looking at deals. So I said, let's just create a simple process to find deals in Pennsylvania. And that's what I did. I go, what's the simplest way to underwrite a deal? And I found this app online, and I could plug in the numbers, and it spits out all the numbers I want to look at: cash on cash return, debt service coverage ratio, everything. And then I just went and I started looking at interesting properties online, and then I started having conversations with the listing brokers. Simple as that. And the listing brokers, if they like you, they're gonna like give you the insight on deals. Like, okay, well, I'm interested in. When they realize that you're not playing games and you're not shopping, like you're serious, if this deal pencils out, you will buy it. And so I did. So I quickly, I bought six doors in like 30 days. And like now I'm like, okay, well, I already hit my goal. So I didn't set my goal high enough. I probably should have said 30 doors, right? Because I would have achieved that. And now we're at the 6 month mark, actually past the 6 month mark. So we're halfway done with the year. So now I have to readjust my goal. So move the needle every day, whether that's you're starting a podcast and you do a episode you want to do 2 episodes a week. It's simple. You set up a simple SOP, standard operating procedure. You implement that, and then you just make it part of the day. You start using the principles of who, not how, meaning you start delegating, and you don't have to be the how person. You just be so like, who's going to edit my podcast, right? That's it. You go find a VA or whoever, or a service that does this for you, right? And you just start stacking these bricks every day. So I would find 2 books that resonate with you, and every year I want to find 2 books that I'm going to kind of live by for that year. So this year it was Who Not How, which is a great book, and then Never Eat Alone was the other principal book. So how do I implement these strategies of these wise people, right? We have all these people that we can go to Audible and we can listen to books. Now I'm listening to Les Brown. He's kind of a motivational guy. So just keep yourself inspired and just realize that like you have to put in the work, and you got to just do it every day. And over time, like you don't feel like you're making progress, but you slowly make progress. And then all of a sudden there's a hockey stick effect. And that was like my podcast, for example. Like the first 100 episodes, you get no traction. Most people quit after episode 8. But I didn't. I just kept going. I just kept going and going and going. And now, I don't know, 200 plus people last year wanted a scheduled time to talk about financing because I just stacked those bricks. So whatever your goals are, whether you want to do wholesaling, you want to buy probate properties, right? If you want to buy probate properties, you have the person right here that can educate you. You follow the recipe. You keep doing it. You're not going to probably get results for 3 to 4 months, maybe 6 months. You just keep stacking and stacking, and all of a sudden you get that first deal, and you make $10, $20, $50,000, right? That's a game changer for most people. And then you go, okay, this is working, so let's keep doing this. How can we put fuel on this fire and keep going? So a lot of people have the intention of doing things. Like I've had the intention of doing a lot of things, but until you just say, okay, every day I'm going to do this. Like every day I'm going to the gym, no matter what. I just instilled that in myself. Every morning I go to the gym. I basically never take days off. Once in a while I have a rest day. But even on days that I'm tired, I go in and just walk and stretch. And so you gotta get these rituals. You have to have rituals.
I love that advice. And Who Not How, it was my favorite book of the last 12 months too. I started looking for who's. Another book that I love that goes along with what we're talking about is Darren Hardy's The Compound Effect, where he talks about doing one thing every day, and you look back at the end of 365 days, and you've made huge strides in your business because you've done that one little thing consistently that builds upon the next thing. So if you guys are looking for a marketing book, I can recommend a marketing book written by Mark Michalowicz. It's called Get Different, Marketing That Can't Be Ignored. That's one of my new favorite books. I'm a marketing nerd. I know Beau knows marketing. So we'll put those books in the show notes, and readers are earners. Remember that, readers are earners. So pick up a book. Beau, thanks so much for coming on the show today. And what's the best way for folks to get in touch with you?
I think the best way is to just go to investorfinancingpodcast.com. That's investorfinancingpodcast.com. There's a book a call with Beau, and I'm happy to jump on a call or Zoom with anybody. A lot of people, I even get on the phone with tire kickers. As long as they don't keep booking multiple, I want action takers. But I don't mind spending, 20, 30 minutes with anybody that just, they can pick my brain or ask me some questions on financing. If you want to buy a business and you're interested in SBA financing, I love talking about SBA financing and how to structure these type of deals, because it all comes down to just creative financing and leveraging, and whether that's working with private investors or different institutional funding sources. There's just a million ways. So happy to discuss anything, and really appreciate you having me on the show. I enjoyed the conversation.
Well, it's been great fun, and we could talk probably for 2 hours. I have like a secondary list of questions I could ask you about the funding process, but go over to the website. I'll put the link there. If you need some type of funding and you're stuck with your deals, as we often get stuck needing a leg up to do something a little bit different, then Beau's your guy. He can help you with all your funding needs. And Beau, thanks again for coming on the show today. Folks out there, thanks to all the listeners that come out too week after week. We appreciate you. If you love this show, and I know you did, please share it and leave us a rating and a review on iTunes. And I will see you all same time, same place next week. Bye for now.